Guys, what is different in sunshine? I'm not going to do the full question, but here also there's quite important stuff which didn't come forward in other questions that you've done. The first thing I want you to have a look is to look at the cash received from customers. There's a lot of catches there. Make sure that you understand exactly what happens there. I also want you to have a look at profit before tax and the taxation calculations in this question. And then look in this question that we have in the income statement, things like discounts received and discounts granted. Make sure that you know what to do with that and against what accounts you should net it off. Now, you should know that from the first semester, so that's nothing new. So let's quickly have a look at the question, and then I'm only going to look at these few things which I have highlighted already. The financial year end is 30 June 2018. They give you the following statement of comprehensive income. Now, this is also a combination question. In the A part of the question, they want the two sections in the statement of cash flow, cash generated from operating activities and cash flow from investing activities. Now, they want you to follow the direct method, and the reconciliation note as well as comparative figures are not required. So I do not have to do the reconciliation note. The B part of the question is a IS1 question. They tell you comment on the correct treatment, presentation and disclosure of the above statement of comprehensive income for the year ended 30 June 2018 in order to comply with the requirements of IS1 presentation of financial statements. You don't have to comment on accounting policy and other notes. So if you look at this income statement that I gave you, you see that the whole thing is actually a little bit cockeyed. We have income, sales, discounts received. Discounts received should not appear anywhere. That should have been netted off against cost of sales. Sundry income, profit on disposal of vehicles, dividend income, current year revaluation of land. They treated that as an income item. It's other comprehensive income. So that should not form part of profit before tax. It should not form part. It must be under the tax line. So watch out for that one. Watch out for this format that I gave you, because that makes quite a difference in your calculations. Then I have cost of sales, admin expenses, credit losses written off, discounts granted. Now where should that be netted off? That should be netted off against sales. So that shouldn't be there either. Sundry expenses, then they give me my tax for the year, 585,439, and then they give us our net profit for the year, 1,765,216. So let's have quickly a look at the statement of financial position. Non-current assets, there's the detail of my assets. Current assets, we have prepaid insurance here, so that will have an impact, the movement on cash paid to employees and suppliers. And make sure here that you understand that cash and cash equivalents are actually those two together. So cash and cash equivalents is not only the bank, it is those two together, so that you're going to look at those movements in order to balance off your cash flow statement. Then share capital, retained earnings, revaluation reserve. Here you can see clearly that there was a movement of 250,000 as you have picked it up, although in the wrong place, but you've picked it up here in the income statement, 250,000. Great. And other items there, you have a mortgage loan, new mortgage loan, current assets, trade creditors, shareholders for dividends, and then income tax payable. The accounting policy is no depreciation on land and buildings, depreciation on delivery vehicles, and an allowance for credit losses is made annually at 5% of the outstanding debtors balances. I'm not going to look at the PPE calculations here. I think we've done enough of that. So I'm not going to look at two at all, except here that they say a portion of land and buildings was financed by that mortgage loan of 750,000. The annual installment inclusive of interest and capital was 97,500. The applicable interest rate is 12% per annum. Now, they only require from you the cash flow from operating activities and investing activities. They do not ask financing activities. Now, you know that you have to split that 97,500 into capital and interest. So what is the interest portion? The outstanding loan was 750,000. The interest rate was 12%, and this loan was outstanding for the full year. So it equals then those two, and that gives us 90,000 rand interest. So the capital repayment of 7,500 would have been the only one that you would have accounted for in your cash flow from financing activities. The 90,000 you know that you disclose under operating activities. Then they give us a vehicle. I'm not going. All sales are done on credit. The company does not make use of allowance accounts for the recording of settlement discounts. The movement of the allowance for credit losses account is included under sundry income. Now you have sundry income here in your income statement of 10,800 rand. And that includes, and you must take it out because the movement in allowance for credit losses does not represent a cash flow item. So remember that one, make a note for yourself. Good, included in cost of sales is an amount of 10,800 rand in respect of a net realizable value write-down or adjustment against your inventory. So remember when you're going to work out the movement in your inventory balances that you're actually going to add that 10,800 rand to the current year's balance when you actually compare that to last year. And that obviously is also a non-cash flow item, that 10,800. There are no differences between the calculation of taxable income and accounting profits except for the treatment of dividends received. That you should know yourself. Order dividends of 8693 was paid in cash during the year. Okay, so let's start then with our cash received from customers. Now, cash received from customers, we know that we need sales and we know that there was discounts that we've granted that we have to account for against sales. Now, in this question, there was credit losses, settlement discounts that I could have taken into account by going the short route. But because there are more than one thing happening, I would strongly suggest that you actually use a T account. The balances that they give you for trade and other receivables, in the statement of financial position, is after the allowance for credit losses was made of 5% of outstanding debtors. So remember that I have to take out the 5% then and gross up the balance to what the balance was before that 5% was deducted. So our closing balance was actual fact 40,100, 38,095 divided by 95%. 38,095 at the opening balance, 48,260 divided by 95% gives us 50,800, and that then is our opening balance. Sales. Now sales, I said, we have accounted here for gross sales, which was the 6.2 million. And then they have actually put the discounts granted of 50,800 on the credit side, 50,800. I would have netted it off against the sales amount, but it will give you exactly the same answer. So 6.2 million on that side, the discounts of 50,800. There was credit losses written off during the year of 3,500 rand. There it is in your income statement. So you have to account for that against your debtors accounts. And then your balancing figure will be the amount that you've received from your debtors, 6,156,400. Now, in your income statement, you have sundry income of 10,800. Now, that also forms part of income. So, sundry income, I want to add to my revenue figure. But remember, included in sundry income, they've told me is the movement. The movement on the allowance for credit losses for the year is included in sundry income. So I'm going to have my receipts from debtors, which is 615,600. And then I'm going to add to that my other revenue, which is not included in the 6.2 million, which I've accounted for, which is the 10,800. But I must remember I have to deduct the movement in the allowance account of that 10,800. Now, how do we calculate the movement? Well, 40,100 was our closing balance, and that times 5% gives us 2,005. Our opening balance was 50,800 multiplied by 5%, and that gives us 2,540. So what did we do during the year? The allowance for credit losses has reduced. So therefore, we debited the allowance account and credited an income statement account, sundry income. It's that one there. So therefore, if we want to account for our other income figure that forms part of revenue, we're only going to account for 10,265, and that will give us total cash receipt from customers of 6,166,665. Now, the only thing that I want to show here, let's quickly look at this calculation of cash paid to suppliers and employees. Now, it starts with profit before tax. Now, if you look at the amounts that they gave you in the income statement, they give you here net profit for the year, and then obviously tax was deducted. That was income less expenses, and that's where they got the tax figure, the net profit figure. So our net profit, the 1765216, is after the tax figure of 585,439 and after the revaluation figure, which they have treated as income. So our profit before tax needs to be adjusted with a 585, which is tax, and I have to deduct the 250,000 because it was treated as an income figure. Now that interest that you see there is the interest on the loan, where they say that no accounting entries have been recorded yet at year end, although the bank statement reveals that the bank had deducted that amount as at year end. So that means that this interest that we've calculated of 90,000 was not being taken into account when this profit figure was calculated. And that is the reason why I have to deduct the 90,000 there as well, which will give you then total profit before tax of 2,010,655. Let's just have a look at our non-cash flow items. Remember that this movement in allowance for credit losses, it was an income, so therefore we have to take it out now, minus 535, and don't forget the net realizable value adjustment on your inventory of 10,800, which you also have to add back. Yes, our credit losses, our depreciation we did calculate, and the interest paid and dividends received, that is then separately disclosable items. Remember here with our working capital changes that with inventory, that you add back the 10,800 Rand net realizable value adjustment when you compare it to last year's balances. Yes, all your PPE calculations, I'm not going to have a look at that. I want us to look at income tax though. Now, the opening balance of income tax, they gave it to us. They said to us that income tax payable 290,700, and there's our closing balance of 218,002. But remember, everything was included in our income statement and in our calculation then obviously for tax, except this interest of 90,000 Rand. So our closing balance, the amount that we owe the receiver of revenue at the end of the year, cannot be 218,002. I have to adjust that, I have to reduce that with a tax on the 90,000 Rand. So if I take that 90,000 Rand and I say, well, what is the after tax impact of this interest? That equals then the 90,000 Rand multiplied by 28%. and that equals 25,200. Interest is an expense. It's a tax deductible expense. So at the end of the year, we're not going to owe the receiver 218,002. We're going to owe the receiver at the end of the year. Let's write it down. So at the end of the year, we're going to owe him 218,002 less that expense that we can deduct, and that then equals, now I'm writing like you're writing in your test, that's why I make so many mistakes. There's 218,002. So at the end of the year, our closing balance of the receiver of revenues account is only 192,802. So therefore, that is the closing balance. Our profit, our expense for the year, our tax expense for the year is our profit before tax, which we have calculated here, 201,0655. You know, and the question also reminded you that dividend income is not subject to normal tax. So therefore, we have to take out the 9,800. That will give us taxable income of 2,855,000 multiplied by 28%, and that will give us 560,239. The 90,000 was taken into account. There it is, when we calculated that figure of 201,0655. So therefore, our tax for the year equals 560,239. You could have done it in a T account format. Then it would have been opening balance 2,0700 plus our tax charge for the year 560,239. Less on the debit side, our closing balance of 192,802, and that will give us tax paid, the bank amount 658,137, 658,137. So this is really what's different in this question. Please have a look at that. It's very important. Make sure that you understand that.